Hi, I'm Dr. John McCallig. I'm an assistant professor of accountancy at University College Dublin. I published a book on introductory financial accounting using IFRS that you can download at the link below. This playlist of videos explains all the important concepts and techniques that are in the book and that you will need to prepare basic financial statements. I've included a link to the playlist of videos below as well. Please remember to like the video and subscribe to the channel if you found this content helpful. This video is about the statement of financial position. The statement of financial position shows us the situation of the firm in relation to how many assets, liabilities and equity amounts it has at a particular point in time. In this video we will look at the definition of assets, liabilities and equity, what they are. We'll look at how they're organized on the balance sheet and how they fit together. And we'll also look at the accounting equation, which tells us how these three items tie together. So assets, liabilities and equity, the conceptual framework, which is a document of the IASB, provides the following definitions of assets. An asset is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. So an asset is something that has the potential to produce economic benefits. It could be something like a motor vehicle that the company has that can provide transportation benefits in the future, a building which provides accommodation benefits, a machine which provides production benefits. It can produce items in the future. So there are a wide range of things that can be classified as an asset. Notice a few things about this definition. It says it's a resource controlled by the entity. So the asset doesn't need to be legally owned by the entity. It can be just controlled by the entity. This makes a difference for things like leased assets, where we don't own the asset, but we do control the use of the asset, and those do show up as assets on an entity's balance sheet. A liability is a present obligation of the entity to transfer an economic resource. So a liability is something that's going to involve us having to transfer an economic resource at some point in the future. This economic resource could of course be cash. We could have to pay off some of our debts using cash, and those debts are liabilities now until we pay them off. Or it could be some other kind of economic resource we need to transfer. It could be we need to provide a service for somebody in the future, or they've paid us for something like a subscription and we haven't yet provided what they have subscribed to. So there's a wide range of items that can be classified, or that are classified as liabilities in the balance sheet, and all of them involve transfers of economic resources to settle them. And then the third category of item is equity. And equity doesn't really have its own definition. Equity is defined in terms of the other two. It's the residual interest in the assets of the entity after deducting all its liabilities. So it's actually assets minus liabilities, and we'll see this when we look specifically at the accounting equation at the end of this presentation. So equity is defined in terms of assets and liabilities. We decide what the assets and liabilities of an entity are, and equity kind of falls out of that equation. Well, what does it mean? Well, it means the bit that's left over, the bit that is not owed to any outsiders like banks or creditors or people we owe money to or people we owe services to, it's the bit left over, the residual interest, and that is the ownership interest. That is owned by the owners of the business. Okay, so let's go and look at a real balance sheet then. This is CRH's balance sheet as at 31st of December 2020. And this is the group balance sheet, and this is usually the balance sheet that we are interested in. It can also be called the consolidated balance sheet. Many big companies like CRH have a lot of companies within a group, and the accounts that we are interested in, or the financial statements that we are interested in, are the group financial statements. That is for all the companies put together, and accountants go through this process called consolidation, where they take all the group companies and they squash them up into one set of financial statements, and you'll see more about that later on in our accounting program. But for now, you just need to know that it's the group or consolidated financial statements that you're interested in. A very important point in relation to the balance sheet is that the balance sheet is prepared as at a particular date. So a balance sheet is like a photograph. It freezes time. It shows you what the position was at a particular point in time. In this case, it's the 31st of December 2020. So the way to interpret a balance sheet is to say that it's a list of all the assets, liabilities, and equity items of a particular entity as at a particular time. We can see in this balance sheet the assets section is up at the top. So we have assets, and we'll talk about the subdivisions in a minute. We have equity items in the middle, and we have liability items down at the bottom. And we'll just briefly go through these items to see what is in each section. Before we do that, I will just ask you to look at the balance sheet. You can see the total assets here are 44.9 billion, and the total liabilities are 24.5 billion, and the difference between assets and liabilities are the equity items, 20.3 billion. Or in the case of this balance sheet, the way it works is that assets equals equity. So it's assets equals equity down here plus liabilities, which is just a rearrangement of what we talked about on the previous slide. So let's go through that balance sheet and look at the various sections in the balance sheet. The first section is non-current assets, and this contains assets that are used on a continuing basis in the organization, or in a longer term basis, at least longer than 12 months. So these are the kind of assets we expect to see around for a while. A big section here is usually property, plant and equipment. So this is all the physical assets of the business, like factories, motor vehicles, office buildings, chairs, tables, computers, all that kind of thing. So those assets are all contained in that heading. These are all tangible assets, and by tangible I mean they actually have a physical presence. You know, they used to say the rule for tangible asset is if you can kick it, it's a tangible asset. The next type of non-current assets are intangible assets, and as you can imagine, these are assets that do not have a physical presence. These are things like a special kind of accounting asset called goodwill that we won't go into at the moment. And then sometimes in specialized situations, things like brands. For an airline, it might be landing slots that they own. For a software company, it could be intellectual property rights, patents, and stuff like that. So these are long-term assets that don't have a physical presence. We also have long-term financial assets in here. These can be long-term investments that we have, or derivative securities, things like options or stuff like that, that we're expecting to hold on to at least into the medium term. And then lastly, we have long-term investments. These are investments in other companies. Now, as we saw on the last slide, from many companies that we invest in are group companies. So if we control them, then they're a group company and they would go into the consolidated financial statements. If they don't meet that criteria, if we only say own 10% of a company or 15 and we don't control it, then they probably go into this category, long-term investments. We now look at the non-current assets section of the Statement of Financial Position. I'll also call the Statement of Financial Position the balance sheet. This terminology is older terminology, but it's still used extensively. Business people will refer to this document as the balance sheet all the time. Property, plant and equipment for CRH is 19.3 billion US dollars. This contains all the cement factories. The CRH actually have their own docks in some countries. They have ships, they have lorries, they have office buildings, they have warehouses. They have all kinds of physical assets, and those are all contained within that section. CRH also have an amount of intangible assets. This is mainly made up of the goodwill asset that I spoke about earlier. Again, we'll defer talking about where that asset comes from. Investments accounted for using the equity method. Well, these are what I referred to on the last slide as long-term investments. Investments in companies that we have a significant holding in, but not enough to consolidate them in with all of our group companies. And then there's a number of smaller items then in the non-current assets section. These assets, they're non-current, they are used on a continuing basis. So we expect to see these assets stay on the balance sheet for a reasonable length of time. Current assets are the next section of the balance sheet. What kind of items do we expect to see in current assets? Well, we expect to see receivables. Those are the amounts of money that are owed to us by our customers generally. So we expect to receive these monies in the future, and they're called receivables. In the old days, they were called debtors. And that term, you will hear that terminology used by business people all the time. Bank and cash, well, that is the amount of money that we have in our bank accounts or on short-term deposit. Prepaid expenses, these are things where we have made a payment for some service that hasn't been provided to us yet. So we may have paid for things like insurance in advance, but we haven't actually used up all of that service yet, and that's a prepayment. And then the last big one for current assets is inventory. This is stock. This is the amount of items that we have in a warehouse or wherever that we expect to sell in the future. So let's have a look at CRH's current assets section of the Statement of Financial Position, or the balance sheet. So these are current assets. These are short-term assets. These are expected to turn over within about 12 months. So it's a little bit more complex than that, but that's a general rule of thumb that they're short-term assets. Inventory, stocks. So CRH have about 3 billion of stock. Trade and other receivables are 4 billion. So that is what our customers, or what CRH's customers owe to CRH. And then cash, 7.7 billion. So they have a lot of cash on their balance sheet at the end of 2020. And that gives us a total for current assets of 14,977. And if you add on non-current assets, which we saw in the previous slides, you get 44,944. And of course, the figures over here in this column, these are the equivalent figures from the 31st of December 2019. So the same figures from last year. The next section of the statement of financial position that we will look at is current liabilities. Current liabilities contains payables. Those are people who are owed money by the organization. These are generally suppliers to the organization, people who supply us with goods and services, and we haven't paid them yet for those goods and services. So that's an obligation or a liability that will have to be settled in the future. Bank overdraft. So if a bank, if our bank balance is overdrawn, we don't show it as a minus current asset. It swaps sides and goes on to the liability side. Taxes. So we may owe some taxes in the short term before we pay them over to the revenue. And accrued expenses. These are the opposite of prepayments. This is where we have used up some services but not paid for them yet. So we may have, used up some electricity or telephone services and not paid those bills yet, and those are shown as accrued expenses. Current means that these are short-term items. So generally, again, less than 12 months. We expect to settle the liabilities that we see in here within 12 months. I guess another thing you can see in here is sometimes short-term debt. This is where some of the debt that we owe is due within the next 12 months, so it gets classified as a current liability. Here's the current liabilities section of the statement of financial position for CRH. We have lease liabilities. These are liabilities for items that we have leased. Trade and other payables, 4.7 billion. As I said, these items are what we owe to our suppliers, so that's quite a lot of money in CRH's case. Current income tax liabilities, so a tax that we have to pay in the short term. Interest-bearing loans and borrowings. Well, this is short-term debt. This is debt that is due within the next 12 months. We'll see when we get on to the next section that the vast bulk of debt is due off into the future. But this is the bit of debt that we're going to have to repay within the next year. It's important to keep an eye on this because if a company has a lot of debt to pay within the next 12 months, then it needs to have some plan that it can pay that debt. It needs to either have cash that it can use to pay that debt or be able to raise more debt to roll over the debt. So that is something we need to look out for when we're doing financial analysis. And then provision for liabilities. This is all sorts of other bits and pieces of liabilities that are in that section. And that gives us our total current liabilities. So these are the short-term liabilities of 7.4 billion. So this just makes that point: when liabilities are not due for repayment within 1 year, they are classified as non-current liabilities, and that's the next section. We won't go through those items. The main item in the non-current liabilities section is the long-term loans and borrowings. This is the amount of money that the company has borrowed and expects to repay after 12 months' time. For CRH, that it's a large amount of money that they have borrowed for the longer term. The equity section shows us what is left over when liabilities are subtracted from assets. It can be called different things in different places. In the US, it can be called it can be called net worth. Some people call it capital, and it can be called shareholders' funds under some UK rules, or stockholders' equity in the US. But in this module, we will call it equity, or shareholders' equity. So here's the equity section of the statement of position, and what kind of items do we expect to see in there? Well, we expect to see really two divisions in here. This first division here, these three first items, and you can see they haven't changed between the 2 years. The equity share capital and the share premium account, that is the amount of equity that shareholders have actually directly contributed to the company. So they've bought shares in the company. That means actually giving the money, real money, to somebody like CRH and getting shares back in exchange. And a share is, in the old days you got a share certificate which says you own this tiny little part of CRH. So shareholders have paid share capital of those three amounts there added together. There are preference shares, and those are kind of a special kind of share. We'll see more about that later on in the module. Equity share capital, that is what we call the nominal value of the shares. Every company has a unit in which its shares are denominated. Usually it's a euro or a dollar, or it can be anything really, but you've got to set it up when you set up the company, the nominal value of the shares. And when shares are issued, the nominal value goes in here into equity share capital, and any excess over the nominal value goes into the share premium account. And if you add the two of those things together, you will get the total amount that shareholders have contributed to the company. I'm just going to ignore the treasury shares because they're a bit technical. The other big account that we want to worry about here is this account, the retained income account. And the retained income account represents the profits of the company from the time it was set up to now, minus any dividends that have been paid out of the company. So what it does is it tracks the surplus that has been generated in the company and looks at, it tracks the surplus that's been generated and adds that on to the shareholders' equity. When the company generates profits and doesn't pay them out as dividends, then it is increasing the equity of the company that is belonged to the shareholders. And that then gives us our total equity down here of 20 billion for CRH. So a very important thing to appreciate in relation to the statement of financial position is the accounting equation, because that's what makes the statement of financial position work. And the statement and the accounting equation says that assets minus liabilities equals equity. And I want you to think about that in this way. Supposing you have a house and the house is worth like 500k. Okay? And you have a mortgage of 300,000 on the house. So the liabilities then are 300k. Then you would say in pretty normal language, 500 minus 300, I have 200 of equity in the house. So what does this mean? Well, it means the bit that belongs to you. And it's the same in a company's financial statements. Equity is the bit that belongs to the owners of the company, the bit that belongs to the shareholders of the company. And that's how the statement of financial position works. And we'll see, it gets a bit tricky down here because we have to, every year we have to update the equity with the what goes through the profit and loss account and stuff like that. And we'll explore that as we get further into the module. But right now, you just need to remember this accounting equation and we'll be using it very soon to see how you can record individual transactions, because they always have to, every transaction you record has to be in accordance with this accounting equation or else the statement of financial position would not balance, and you just would have a mess. Okay, so thanks for listening to this video. This video has been about the statement of financial position. Thank you very much. Remember to like and subscribe if you found this content helpful. Bye.